Marie, what would your pump up song be if you had to have a pump up song?
I cycle between, I have a pump up song
Oh,
when I'm
you do?
setting up
Okay.
my YouTube space. It takes like 30 minutes. So I have a few songs, I should say. I do almost anything BTS.
Ooh,
And
that's
then
good.
I have some weird ones. I really like that song from like 10 years ago called Bang Bang. That's like Ariana Grande,
Oh,
Jessie
yeah.
J, and Nicki Minaj. The lyrics are one thing, but the song is it's
It's
a
a
good
catchy,
pump up
catchy
song.
tune. Catchy tune.
Sure.
Yeah, yeah, those are
I am a big Swiftie. I know that I don't ever shut up about it, but I'm like anything Taylor Swift is my jam.
yes, true as well. Yeah. Andrew, do you have a pump up song?
What would my pump up song be? I'm trying to think like let me see like what have I been listening to lately? I'm ashamed to admit I've been listening to a ton of just like older Justin Bieber lately. He has
Why
this
are you
album called
ashamed?
Change. I don't know why I felt the need to qualify that, Marie, but there's like he has
No
this old
shame.
album called Changes and it's just so good and so catchy and I have listened to that a number of times that I would not like to readily admit on this live webinar right now.
What are your like top tracks from that album?
Ooh, top tracks. I do like Changes. Let's see. Let's look at the album. Um, Available and ETA. Those are probably the three that I'm vibing to right now.
Okay, I need to look that up. There was like an era of like when I was in grad school that I just didn't know what was happening in pop culture, and I wonder if it's like from around there. Are they like older, like
It
10
could
years
be.
old?
I bet it's probably like 2016 or
Oh, never
17. I
mind.
don't know.
Oh no.
2020.
Oh,
This is what
that's
the
not
COVID
old.
era has done to us. I
Okay.
have lost track of a number of years.
I
Awesome.
need to look up his 2020 stuff.
Cool. Well, I think we can go ahead and kick us off.
Awesome. Are you passing the baton to me, Brittany? Well, thank you everyone who's here. Hopefully it's such a bizarre thing. Like I know you're all here, but then I don't see you. But it's lovely that you're all here. Thank you for coming. And for those who are watching the replay, welcome as well. And I'm so excited that Andrew and the Herd team are here to teach us about taxes. Literally every time I've spoken about anything tax, accounting, finance related, I'm just like jotting my notes, even if we're recording something for YouTube. So I know I'm going to learn new things today as well. So thank you so much for putting this on, and I'm excited to be here and learn as well.
Yeah, thank you so much for having us. We're stoked to be here as well. We've been working with Marie on a lot of different things, whether that be podcasts or content, for a while now. So we were talking earlier, and like it's so nice to see you and hang out here. So today we will be going over preparing for 2023 tax season. And Andrew will be going over the slides, and then Mike will also be there in the chat to help support. If you have any questions, please feel free to drop them in the Q&A. We're going to stop after each slide and answer any of your questions. We want this to be as interactive as possible. So any questions, no question is too simple. Likely if you have the question, someone else has it as well. So we'll go ahead and move forward here. Tax season is stressful. You got this. We understand that it feels like a big hill to climb over. That is what we are here for. So here to support you in that way. And just a little overview about Herd if you're unfamiliar. Herd is an all-in-one financial solution for therapists that handles your bookkeeping, your taxes, your payroll. So we take that stress from you so you can focus on your clients and the other things that are important to you in your life. And then really quickly, we have a special offer if you sign up through Private Practice Skills. You get 50% off of your first 2 months if you scan this QR code and use the code Marie when you sign up. And if you want to talk to someone before you sign up, we offer free consultations. Definitely recommend doing that to make sure that Herd is a good fit for you and your practice, because we also understand that everyone is in a different place in their practice. So we want to make sure that our services are something that would work for you. All right, and a brief agenda as we go over here. We're going to talk about organizing your finances, what to bring to your tax preparer, how much you need to set aside for taxes, and how to claim any possible tax deductions. So get your questions ready and we'll kick this off. I'm going to go ahead and throw it to Andrew.
All right. Thank you, Brittany. And as always, thank you, Marie. Very grateful to be here. Excited to have this conversation and really just pumped up more than anything to be here to talk to you all about bookkeeping, taxes, and payroll and all of that nerdy stuff. Before we get going, I just wanted to say kudos to you, not just as clinicians, but as small business owners for showing up at noon, or for some folks 2 p.m. and for other folks 3 p.m. on a Tuesday to listen to this human nerd out on accounting stuff. One note, don't expect to come out of this workshop having been an expert in all things taxes. If you come out of this workshop having learned one new term, one new thing that you can research, one new thing that you can ask a peer colleague about, I would consider that success. And so again, this is a conversation to just learn, to educate yourself, and to dive into some stuff that's probably new for a lot of folks on this call. And so there is absolutely zero expectation that you will be an expert. And one caveat, if I am using words that you've never heard before, which is 100% likely, maybe even 110% likely, please drop questions into the chat. Say, Andrew, you used, this description of this specific form, or you used this specific word. Like, what does this actually mean? Other folks on this call will thank you. And so with that, I will go ahead and jump right in. And at the end of every slide, as Brittany mentioned, we will pause to answer any questions. And so it makes it a heck of a lot more fun for me to answer your questions throughout. So please jump in and join in on the fun. So when you're thinking about filing taxes at the end of the year, you want to think about organizing your finances and really thinking about getting prepared. Not only is this going to make a very, very happy accountant when you go to file taxes at the end of the year, but it's going to make it a heck of a lot less stressful for you when you go to file returns at the end of the year. And so I'll use this word bookkeeping to describe what getting prepared and putting your finances together looks like, but we don't need to overcomplicate it with a term. What this just means is, as a self-employed therapist, you're responsible for showing up at the end of the year when you go to file your tax return, having gathered all of the information to support the income that you're representing to the IRS, as well as the expenses or the deductions or write-offs that you are presenting to the IRS. If you are using bookkeeping software, so if you're using something like Herd, if you're a Herd customer, hello and welcome. Or if you're using something like QuickBooks or Wave, you can find this information in your profit and loss. And one of the benefits of using accounting software, bookkeeping software, and having that separation of personal finances from business finances and having it flow through software is that you have it all in one place and you're able to access it at any point in time, as opposed to keeping a paper ledger or putting together a spreadsheet on a week over week or a monthly or an annual basis. It'll save you a little bit of time and make sure that everything's in one place. One other just piece of advice that I would provide is just keep receipts for any business expenses of $75 or more. Specifically as it relates to vehicle use for business, meals and entertainment, any sort of travel expenses. These are the areas that the IRS is going to typically dive a little bit deeper. But more broadly, if you want to have a best practice as it relates to keeping track of your finances, my big recommendation is just keep track of every receipt that you can within reason. One thing to note is that most receipts in the digital age are accessible. So whether you paid for something at Amazon or whether you paid for something at Target, as long as you know that you can access those receipts in due time, if there is ever an audit that takes place, you're going to be setting yourself up for success. But again, the more organized you are and the more you keep these receipts on hand, the easier it's going to be when you go to file returns at the end of the year.
Awesome. Thank you, Andrew. And as a reminder, if you have any questions, feel free to drop them in the chat. I see a comment here about saving a receipt for your $4 latte, unless you're claiming that as a business deduction. If you had a meeting that you can claim, yeah, you would not need to keep that receipt. All right, and want to do an audio check-in. Does the audio feedback sound okay? We got a message that
Let me do a quick check. How does that sound?
sounds good on my end.
Cool.
Awesome. So we can go ahead and move forward here.
All right. So what do you bring to your tax preparer? So you've gotten all of your quote unquote bookkeeping together. So all of your income and expenses you've brought into one place. What are the other things that you need to bring to your preparer at the end of the year? Or if you are doing it yourself and want to use TurboTax and you or your partner are filing that, what is the information that you're going to need? First of all, you're going to need income statements. So things like W-2s, 1099. So any sort of income from simple practice, any sort of income from insurers that you're working with, any sort of income from EAPs that you might be working with, or maybe you have a merchant or payment processor that you're processing income through, like Stripe or Square, that will provide you a 1099 at the end of the year. Anything associated with an S Corp or royalties that might be coming on a separate business tax return with income that you're reporting back on your individual tax return, so a Form K-1. And if you bring all of this to your accountant, they are going to be very happy. And if you bring all of this to file it yourself, you are going to be very happy and you're not going to miss anything when you file your return. If you have a full-time job, you'll receive what's called a W-2 from your employer. And if you are an independent contractor or receiving payment through a merchant or payment processor, you will receive a Form 1099. There are lots of different acronyms that exist on the back of this 1099. So you're probably like, well, is it a 1099 MISC? Is it a 1099 NEC? What is the actual form? And so just trust that when you are working with one of these organizations, whether it's a payment processor and you're managing the payment yourself, or you're working within, an EAP like Lyra, they'll provide you that information at the end of the year and make sure that you bring that. If you're self-employed as a sole proprietor, you are going to file a Form 1040. This is your personal tax return. And what that means is alongside of your personal tax return, so maybe you were a W-2 in the prior year, and in the current year, you've stepped out and started building a private practice, which is amazing. Shout out to all the folks on the call that did that this year. You're going to start by filing what is called a Schedule C. And what this is representative of is, again, your business income and expenses. So make sure that you keep track of all of that throughout the year. One thing to note is if you have been in business for a period of time and you've identified that structuring yourself as an S Corp will be tax advantageous, what that means is you'll also be responsible for filing a separate business tax return or a Form 1120-S. And when you complete that Form 1120-S, you will then report that income or taxable income from that Form 1120-S back onto your personal tax return. I'm happy to pause and answer any questions here, as I'd imagine there's probably a few coming up.
Yeah, definitely. Awesome. So a quick question here. If I receive a 1099 from BetterHelp, do I also need to file a 1040, or would that 1040 only be filed? Sorry, my computer just went dark. Would that 1040 only be filed if I'm receiving income from, say, private pay clients outside of BetterHelp?
Great question. So every single person on this call, assuming that you are a US resident or an American resident, you will be responsible for filing a Form 1040. So the Form 1040 is what all individuals in the United States file each year when they go to file taxes, if they are responsible for being a taxpayer. And that could be you as an individual, that could be you as head of household with a child or somebody that you're responsible for caretaking. It could be you and a partner. And so that Form 1040 could include a number of different circumstances, but everybody at the end of the year will be responsible for filing the Form 1040. And so what that means is with the 1099 that you receive from BetterHelp, you'd report all of that income on your Schedule C. And so even if you had cash pay income and BetterHelp income and income from an EAP, and maybe you're doing, speaking engagements as well, if you're like Marie on this call, you would gather all of that income together and report all of that income on the Schedule C. Great question.
Yeah, very great question. All right. And then as a reminder, if you could drop your questions into the Q&A, it'll be easier for us to make sure that we get to them. Okay, good question here. If we are a sole proprietor, should we file it with our individual taxes, for example, with spouse?
Yes, that's a great question. So even if you have a spouse, so let's imagine an example here. Brittany's therapy practice. Welcome back to Brittany's therapy practice. We love to use her as an example. Brittany has a partner that she is married to, and they've determined that they want to file jointly this tax year because from a tax saving standpoint, it makes the most sense for them as a family unit. And so in this example, Brittany has a W-2, so a full-time job. She's working at an agency. She's also stepped out and she is seeing 10 cash pay clients on the side. So she would have her own Schedule C. But then her partner as well, she is running her own business. And so she is I don't know why this example is coming to my mind, but my mom always says underwater basket weaving. So she's running an underwater basket weaving business, and her partner will then be responsible for her underwater basket weaving business to file a separate Schedule C on the Form 1040. And so it's possible that if you have multiple different businesses, or if you do multiple different types of work like Marie on this call, you might have multiple Schedule Cs if you're filing as a sole proprietor, but ultimately all of those Schedule Cs will show up on your Form 1040. Great question again.
I am always fascinated by each situation that you come up with for me and my hypothetical partner. So I love it.
You have to do so many different things, Brittany.
So many different things. Awesome. All right, we're going to go ahead and move forward here.
Awesome. We won't spin the wheels too long on this because we have some awesome content that we've put together that we'll share after the fact, so you don't have to fervently or furiously take notes while we're going through the slides. But important things to bring when you're going to file your returns as well, outside of just the income and expense documents that we've talked about. Prior year tax returns. If you're working with an accountant, the number one thing that they're going to ask you is, please provide federal and, where relevant, state tax returns. And that'll typically be from the prior 2 to 3 tax years. And why they want to understand this is they want to see, what does the full picture look like? And so basically the way I describe a prior year tax return to an accountant is like, it's like the strand of DNA that describes who you are as a tax filing individual. And it's the basis from which we'll ask all of the other questions to really understand what those changes look like over the course of the year, because we don't want to miss anything. And there's so much going on the tax return that having this historical data is really helpful. So similar to how you do an intake as a clinician, us doing an intake is going to involve gathering all of those prior year tax returns. Tax deduction records. So things like medical expenses, mortgage interest statements, charitable donations, childcare, college tuition. There's a number of different things that you'll want to bring, but any big expenses that you've paid for, my piece of recommendation is going to be bringing everything that you feel like, I paid for this and I should probably write this off, or think about writing it off, or can I write this off? Bring all of that stuff to your professional at the end of the year and let us be the one that tells you, oh, this is something that we can't take advantage of. An example of this would be like student loan interest. You know, a lot of folks will come to us and be like, can I write off the student loans that I'm responsible for paying for? And the answer to that question is no, but you can write off the interest that's associated with it. So gathering all of those deduction records for us will be really helpful in us fact gathering as we approach tax season. Tax forms that report other types of income. So rental income, investment income, trust income. Maybe you're an academic or you're working on your PhD while you're running your practice and have scholarship income. Or maybe you have grant income if you're like my partner, if you're doing research as well. Alimony, another example of that. Any sort of income that you're earning, of course, bring all of these forms forward. And these forms that we're talking about right here are related to you as a personal taxpayer, separate from you as a private practice owner. Other tax forms, things like insurance from the marketplace. If you're paying for insurance through the marketplace, there are certain credits from the prior years that if you didn't take advantage of, and you're working with a new accountant that sees that you didn't take advantage of those, that you can take advantage of in the current tax year. And we love to get all of the credits we can because that is cash directly back to you. The other piece is personal documents. So we will ask you for every possible thing that describes and shows who you are as a human being. So social security number, if you have a tax ID or an EIN that you've set up, bank account and routing information for, either payments against your tax return or payments from your tax return. And so be prepared and know that we're going to ask you a lot of questions, and it'll probably go beyond the scope of some of this information here. But just trust that when we ask you all of these questions, it's because we want to help you save as much money as we possibly can.
Yeah, a good rule of thumb that we have talked about is if you think you might need to bring it to your accountant, bring it to your accountant. There's similar to when you sign up for therapy, your therapist needs necessary context to provide treatment to you. As an accountant, we need necessary context to help you with your finances. All right, and let's see. It looks like, okay, got a good question here. As an S Corp, you pay yourself a salary. Is this salary listed on a Form 1040? Is this salary listed on the 1120S as a business expense?
Boom. Great question. We removed S Corp from this presentation, but I am more than happy to breeze over it. And Michael, I promise I will do it very quickly. In the context of tax filing at the end of the year, as it relates to the W-2 that you're paying yourself from your S Corp, it'll be representative of, so if it's a payment to you, it'll be compensation for officers. So there's a specific line item, which us nerdy accountants will call it, as an expense on your Form 1120S. But if it's for employees, it'll be payroll expenses. And so two separate line items on your 1120S. If you have employees that you're paying, it'll be a payroll expense and you'll have payroll taxes and all of that good stuff. If it is paying yourself, it would be compensation for officers, and that would be the owners or the employees of the S corporation.
Awesome. Wow, that was quick, Andrew. Okay, if we have a private practice and we are the only employee, does everything we make count as our income?
One thing I also wanted to be clear about there. So you will report it as an expense on the 1120S, but it'll also be a W-2 that you report on your individual income tax return as you would any other W-2. So two places, it'll be on the 1120S as an expense, and then you will report that W-2 income on your individual tax return. Brittany, I got distracted because I wanted to make sure I said that. What was your question?
If we have a private practice and we are the only employee, does everything we make count as income?
Yes. The unfortunate reality is more money, more problems. As you make more in your independent practice, you will have more income that you're responsible for reporting. And so we'll talk through lots of different deductions and expenses a little bit later on that can reduce that overall income and get us to a better taxable income or net income at the end of the year. But yes, all of the income that you earn in practice, you will report. There is, again, like our friend that asked the question about an S Corp, an opportunity to find tax savings if you do elect to be taxed as an S Corp in certain circumstances at a certain threshold of income. But an S Corp is not right for everybody in their practice. But in that case, you would have two separate forms of payments, which would be an owner's draw, and then you'd also have a W-2.
Awesome. All right.
Awesome. So how much to set aside for taxes? How much to pay? So whether you are whether you're a part of a Facebook group or a membership or some sort of listserv, we often have folks that come to Herd and they'll say, we heard 25% or 30% or 40% is appropriate for me. And the reality is, it may be true for one person, but it's probably not true for the other person because every individual is unique and the effective tax brackets are associated with you as a tax entity. And when I say that, I mean Brittany and her partner that does underwater basket weaving, or Brittany and her partner and their child. There is an impact based on the overall picture financially and what income is included in that as to how you think about the overall effective tax rate. And so best practice, of course, if you have, chosen to DIY it and you're not going to work with a professional who will help you, 30 to 40% is a good rule of thumb of business profit, and that is income after expenses for taxes. And this will help you cover things like your federal income tax, your state income tax, or if you're in New York City, there's probably a few folks on here, things like city or local taxes as well, which aren't super fun, but oftentimes the case is in big cities. But this will also be responsible for helping to cover some of that self-employment tax that you need to pay as well. How to pay. So if it's at the federal level, you can pay online via the IRS website for your federal taxes, and the self-employment tax, when you think about that 15.3%, would be included within the federal taxes that you're paying. And then again, your state department as well, typically for both your state and local. Sometimes there's separate portals for local or city taxes. You can also pay by mail. But one thing to note is that every state is totally different on how easy it is to pay at a state-by-state basis. We do have a great guide of how to pay on a state over state basis. So I'd imagine Michael can share that, or if we don't share it during the call, we can share it after the fact. But don't get frustrated if you get to the state website and find out that you have to walk through 15 different loopholes to figure out how to actually pay the taxes. Fortunately, while these are incumbent institutions, most of them have figured out that they want to get paid. And so it's pretty seamless on how to do it, but some can be a little bit confusing. When to pay. So there's two different frames that I'll look through here. So you have an annual tax liability, and you're responsible for paying that on March 14th, March 15th, or April 15th, depending on which tax return that you're filing. March 15th for a business tax return, April 15th for your personal tax return. But you are also responsible as a self-employed individual for making estimated payments on a quarterly basis. And as a heads up, if you haven't made any payments this year, the Q4 payment is due on Jan 16th. So if you have not made any payments this year, that is totally, totally fine. Everybody has a starting place, or everybody has prioritization. So maybe it's that you had personal expenses that you had to account for, that you were responsible for, that were a higher priority than making those estimated payments. That's totally fine. You may be assessed penalties and fees for not paying in estimated payments on a quarterly basis, but you can always play catch up. And so there is an upcoming payment. And if you haven't made any payments, my recommendation would be identifying how much you owe. Again, we can help you with that at Herd. Another accountant could help you with that. There are some calculators online that you can use, but again, my recommendation here would be working with a professional. And then you can pay the remaining amount when you file your tax return. What happens if you overpay? You're going to get a refund. And if you don't pay or you underpay the minimum amount that you're responsible for paying throughout the year, you may be assessed a penalty at the end of the year, which is totally fine. And I know a lot of you are thinking, oh my gosh, how much is this penalty? What is it going to be? It is typically in the range of 0.5% to 25%, but it does not usually compound until after the annual filing date of April 15th. So some accountants will even say, oh, don't pay in throughout the year. But the reality is the IRS guidance and codification is quite clear in that if you're going to have a tax liability of over $1,000 over the course of the year, meaning you'll have, anywhere from $4,000 to $5,000 as a minimum of self-employment income, that you'll be responsible for paying quarterly taxes. And so our perspective is the guidance is quite clear. Go ahead and make those payments.
Awesome. A lot of great questions are coming in here. And I see we have a question about any handouts, which I know we always call to Mike on this. We just recently launched a tax hub on our website. So that has a lot of helpful downloadable resources, as well as deadlines, as well as blogs that are directly related to tax season for therapists. So Mike will drop that link below. Do you pay quarterly taxes at the same time, or do you pay Q4 taxes at the same time as annual federal taxes, separate checks, or all together?
Great question. So the payment deadline for the Q4 taxes, that would be January 16th. And it may be that you're filing taxes as early as January 16th. I would imagine it's probably after January 22nd where you start filing, just because you'll want to make sure that you've received all of your potential tax forms, and that's the deadline for all of the tax forms from different institutions to be provided. And so probably unlikely that you'll be crossing over payments there. But if you are making that quarterly estimated payment, there is a separate pathway that you'll take associated with your estimated taxes against that annual liability than the payment pathway that you would take when you're filing your annual tax return. And so two separate pathways of how you'd be able to make that payment. You would make it on the same website, but it would, again, be two separate pathways that you take.
Awesome. And we got a couple questions about this. If it's my first year of private practice, do I need to pay quarterly taxes? I don't really know how to calculate my income because it's my first year.
Awesome. Well, first things first, if you haven't started kind of keeping track of your income and expenses, I'm going to assume that you probably, and you know what they say about assume, to assume makes an ASS out of you and me. But I'm going to assume that you probably use an electronic health record system. And so something like Simple Practice or Therapy Notes or Intake Queue, one of the many different EHRs that do exist, you're receiving income through there. They probably have reports of how much income that you've earned. And then that that EHR will then move that money to your bank account. And so you have a centralized look at what that income is. And so my recommendation on a monthly basis, just as a place to get started for you before you set up any other systems or processes, bring that income over from the EHR, put it in a spreadsheet, and then on a month over month basis or as expenses take place, as any expense that you feel like is associated with your private practice starts to show up, just add that into the spreadsheet. And then at the end of the month, on a month over month basis, you can get a look of, okay, roughly I made this much income. Okay, roughly I had this much expenses. That'll get you back to a place of, okay, I feel like I'm starting to get to a place where I have an understanding of how much I'm making. And then from there, from a calculation standpoint, my recommendation would be either leveraging an online calculator. They're going to be pretty rough and probably a little bit off, but can get you directionally in the right place as to how much you think about paying. Or you have a conversation with a professional and they can help you think about how to pull all of that information together, get a good bookkeeping process in place, and get a good sense of what your income looks like for how much you need to set aside. Of course, we can do that at Herd. If you want to DIY it, you could use something like QuickBooks or Wave to keep track of that. Or a local or regional accountant might be able to help with that. But again, I totally understand the stress of being in practice first year and trying to tackle all of this. My recommendation would just be start at an easy place, bring it into a spreadsheet, and even this number above of 30 to 40% of business profit, that would be a great starting place for you.
Awesome. Great questions, everyone. Cool.
Awesome. I thought it would be really helpful to talk through just a couple different examples because we oftentimes get a lot of questions around what is my tax rate? And while I wish I could calculate everybody's effective tax rate on this call, I thought it would be helpful to just go through a couple. So sole proprietor therapist filing single on their individual tax return, earning $90,000 in San Francisco, they're going to have a federal tax rate of about 14%. They're also going to be responsible for paying an additional 15.3% in self-employment tax. And so what is self-employment tax? You can think about that fairly synonymously with the payroll taxes that you would have otherwise been paying if you were working for a full-time employer, if you had a part-time job that provided a W-2. These are things like Social Security, Medicare, unemployment taxes. And so as a small business owner, you're not paying into that because you don't have a W-2. So you're responsible for actively making those payments throughout the year. Your state tax rate would be 5%. And so that would bring our total rate to about 35%. Note here, I do want to call this out, is you will be able to deduct 50% of that self-employment tax on your personal tax return. This is a benefit for self-employed individuals because think about if you have a W-2, there's an employer, there's an employee, and the employee is only responsible for those employee side taxes. And so this is bringing it back to a little bit more of the fairness mark. And so you can assume that this rate will reduce a little bit, but again, in this example, you're thinking about 35% for about $90,000 of income, which could feel surprising for a lot of folks on this call. Let's go to the next one, and then we can take questions after that.
Cool.
Okay, cool. So scenario number 2. So let's imagine you are married filing jointly. And so Brittany has a part-time practice where she's earning $40,000. She also has that agency job where she's earning $50,000. and her partner is absolutely crushing with the underwater weaving, underwater basket weaving business, making $200,000. And so why I want to talk about these examples is that even though Brittany in the first example as a single individual in her private practice is earning more money than this therapist also has W-2 income, and this therapist also has a partner that's earning over $200,000, so a high earning partner. Immediately, Brittany is now in the 30% federal tax bracket, approximately, plus that 15.3% of self-employment tax. And then at the state level, she's also at the 8% rate. And so that brings her total rate of about 50% because she has a high earning partner and because she's doing quite well in her practice as well. Again, 50% of the self-employment tax will be deducted on your personal tax return. But this is to note that it can look totally different based on their individual circumstances, the state, the city that they're living in, and how they're approaching filing taxes at the end of the year. And some people may have passive income as well that's not being accounted for in these examples. And so really get a sense of what that full picture looks like, because that can really influence the amount that you owe.
Great examples. Awesome. This is a really, really great question. If I took a break from my business, no clients for about a year or something, do I still need to file a Schedule C, or is that only if you have income?
I took a break from my business, no clients for about a year. So as long as you have no income, or you have no income that supersedes the expenses in your practice, you will be okay and will not need to file a separate Schedule C at the end of the year. My typical recommendation is, if you do have any income and you do have expenses that supersede, to just go ahead and file the Schedule C at the end of the year anyways. But if you have no income and no expenses associated with your practice, and you've taken the year off, or there were personal circumstances that led to that, again, you're totally not responsible for filing that at the end of the year. Great question. Thanks for bringing that up.
Awesome. And then this is a very common question, since I know a lot of us are working remotely. So I know a lot of therapists moved into the telehealth space. If I'm offering telehealth in a city, do I still need to be paying city tax, even if I'm not serving anyone directly in that city?
Great question. And this gets into the topic of kind of multi-state or multi-jurisdictional, which makes me sound very smart, taxes. And this can be very, very complex. And so there's no silver bullet answer to this question. The reality is that every state and every county and every jurisdiction has a different way that they approach this concept of what's called tax nexus, which means different events that will trigger or cause you to owe or be responsible for paying taxes in that specific area. This can be income thresholds. This can be physical presence. So it could be you actually physically living there, or you traveling there X number of times throughout the year. And so this is the recommendation, where if you do have a practice that is at the multi-state level, or maybe you're leveraging something like SIPAC and operating in multiple states, to where you could be tripping a nexus threshold or a nexus triggering activity in a given state, my recommendation would absolutely be talking with a professional, because you just want to make sure that you get it right, even if it is just a one-time consultation, because that can make things awfully tricky. And to note as well, like even at the tax preparer level or the CPA level, I used to work for a big public accounting firm called PricewaterhouseCoopers. They're doing a ton of research and putting together publications and guidance on all of this right now, because a lot of this is coming through the pandemic that took place and the broader shift into the home office situation. And so you can also assume that there's probably going to be a lot of changes on a year-over-year basis.
I know times are genuinely, I feel like everything is different every couple of months. So always changing. Great. Okay, gonna go ahead and move forward here.
Awesome. So we want to claim all of the tax deductions that we possibly can. And so let me describe what is a tax deduction or a write-off, because a lot of people on here are probably like, Andrew, what the heck are you talking about? People say deductions, people say write-off. David from Schitt's Creek, thinks that he can write off anything that he spends money on. It's just not true. Sorry, David. But a tax deduction or a tax write-off is any business expense that's ordinary and necessary in the eyes of the IRS. And so You're like, great, Andrew, super helpful description. The reality is there is a ton of guidance and frameworks for basically every different category of write-off that the IRS has. And not a lot of them are super clear. And so it sets up the opportunity to really think on a scale from conservative to aggressive of how you want to approach your business expenses and write-offs at the end of the year. But my piece of advice or piece of feedback, and we alluded to this a little bit earlier, is if it looks like a business expense, if it smells like one and feels like one, bring it, document it, and bring it to your accountant and let a professional make the decision as to whether or not they're going to write that off or help provide you the context so you can make the decision of, okay, I want to be a little bit more aggressive here, or maybe in this area, I want to be a little bit more conservative based on the guidance that's been provided. And so again, a tax deduction or a write-off is any business expense that's ordinary and necessary. And so a personal retreat to Tulum to just get away and recoup, probably going to be a little bit more challenging, but that conference that you're paying for that you need to travel to on a year-over-year basis for your state licensure board, or a specific modality that you're a part of or approach that you use in your practice, absolutely going to stem or create a number of different ordinary and necessary business expenses. Business expenses reduce your taxable income. And so you have a total amount of money that you earn in your practice. So again, you have those 1099s from the EAP, from the insurers, from all of these different locations. And then you have expenses after that that are going to reduce that overall income that you are bringing in for your private practice. And so any business expense will lower your tax bill, but don't just spend, in this example, $1 to save 25 cents. Spend the money that's necessary in your practice and also explore some of these different things like a home office deduction or indirect expenses like internet and phone bill and things like contributions to your SEP IRA or your solo 401k or a tax deductible retirement account. And so there's different ways that we can go about saving money. But if you're in the place where you've made a lot of money and you haven't spent a lot of money and you've explored all of these other indirect ways of saving money on your taxes, don't just spend money for the sake of saving money. Again, more money, more problems. Document everything. Again, it's important to document your expenses so you can write them off on your taxes. And so we talked about that $75 threshold. I think that's a good kind of rule of thumb that you can leverage and think about when you're documenting all of your expenses and bringing in all of your receipts. Again, document the expenses, but as it relates to the receipts, the reason that you need all of this documentation is if an audit ever does take place, again, that likelihood is quite low. It's typically under 1.5% of overall returns get audited at the end of the year. But in the case that it does happen, you want to make sure that you have all of the information necessary. And the way that this typically takes place is they'll choose a specific line item or expense area that feels maybe like an outlier. And my sense is that they probably have an algorithm or some approach on the back end that's flagging specific accounts either randomly or also based on a dollar threshold. And so let's say if your travel expenses for the year surpass a certain threshold, then you'll be more likely subject to an audit for those specific circumstances. And so be responsible and be thoughtful as you relate or as you think about approaching your expenses at the end of the year, even if you do want to take a more aggressive approach.
Yes, tax deductions are always a big hot topic. And Mike just dropped in a helpful article that we have on our website about important and common tax deductions for therapists. As just a general question, when you say like writing something off, what does that look like? Who am I submitting papers to? Where am I writing this off?
I was trying to find the mute button. I can do technology. What do I mean when I am saying write something off? So I talked about, let's imagine that you're a sole proprietor. I talked about the Schedule C that you'll be responsible for filing on your individual tax return. And so what a write-off is, I'll kind of talk about this twofold. So you have your bookkeeping that you're responsible for throughout the year or tracking of the income and expenses. So you'll track all of those items. You'll have, EHRs, you'll have meals and entertainment, you're going to pay to go to events, you have software that you're paying for, all of that good stuff. You'll keep track of those expenses throughout the year. And then if you're keeping track of this in a bookkeeping process, you'll be categorizing all of those expenses. And then the categories of expenses, or the aggregate sum of those expenses in those individual categories, then translate back to specific lines or areas of write-offs on the individual tax return on your Schedule C. And so you have expenses, those go into specific categories, and then those categories map back to the tax return on a specific field. Great question.
Now I lost my mute button. Awesome. Okay, I'm gonna go ahead and move forward because we're getting some tax deduction questions, and we have a good, helpful slide on that.
Awesome. So this will be overwhelming because I'm going to describe a lot of different things, but we also have a good amount of time. So I'm happy to just pause and answer some questions here as well. Advertising and marketing. So things like updating your website, getting a new headshot for your website. Maybe you paid for the visual design for your website. Maybe you're paying for an SEO consultant to help with you. You could be paying for things like Google Ads or ads on Facebook or Meta. All of those advertising and marketing expenses, things like Good Therapy or Psychology Today, any of the networks that you're a part of that you're advertising your services. Business meals. This could be a meal out with one of your colleagues to do a case consult. You're probably not talking about your case consults in a live public setting, but let's say you grabbed a coffee, the example that Brittany provided earlier, and went for a walk with your colleague, and maybe you grabbed a breakfast sandwich with that. Great example of a business meal. Not a great example of a business meal would be you're operating from your telehealth setting. So Andrew in his physical space going to get groceries for the house that I would have otherwise been getting anyways, probably a little bit more difficult. But let's say that you are operating in a shared space, or you run a group practice that has a shared space. If you're buying LaCroix or other resources or materials to bring, or food to bring to that shared office space, great example of a deduction that you can take advantage of. Vehicle use for business. It is largely my recommendation, unless there are very specific circumstances, that you do not buy a vehicle for a telehealth-based business. That is quite hard to justify in the eyes of the IRS, and that will be an area that they would look at with greater scrutiny. Again, there may be examples where this makes sense. A typical example I use is maybe a provider does OCD specific work and they're going out to do exposures on site with their clients every single time they meet. If that is what they do and they're constantly out there with the client doing exposures, and maybe they're also traveling to talk about the work that they do because they're a rock star at the work that they do, maybe in that example it would make sense. But my recommendation either way would just be taking advantage of the mileage write-off. There is a mileage write-off for any sort of business travel that you are doing, and so as long as you are going from your home office to that business location, so whether it's a client, whether it's a conference, whether you're going to do a speaking event, whatever it might be, you can write off the mileage between your home office and that place. The one area where you cannot write off mileage is between your home office and perhaps a shared physical space or another physical space that you're paying to operate a business out of. Awesome. Membership fees. So clinicians and all business owners, small business owners, are part of lots of different communities and memberships. And so these are all great examples of expenses to take advantage of. I'm trying to think of a good one specifically. Nothing's coming to mind, but there's lots of membership communities that we're a part of. A good example of this is Marie. What folks pay for to be a part of Marie's community on this call, or to pay for the resources or the checklist that she provides, all of the amazing stuff, that is all tax deductible, and you should absolutely be writing that off. And so whether you're a part of her community or paying for those resources, absolutely write that off. Continuing education. So you're responsible for paying for CEUs on an annual or a biannual basis, and there's a certain number that you need to pay for, absolutely write those off. Travel expenses. You are probably traveling to go to conferences. My wife, a clinical psychologist, just went to a conference in another state, and so she was able to write off the Uber to the airport, the flight, the time that she was at that conference, all of the business meals that she's paid for. And so, great example of an opportunity to take advantage of some of those travel expenses. Now, if you extended the stay of that trip and turned it into a vacation, the tenure of that stay, whether it's a hotel or meals, those will be a little bit more challenging to take advantage of. But again, make sure that you're keeping track of all of your travel expenses. Office expenses and supplies. I have this pen holder with my favorite pens. I have this camera, my cool light that lights me up while I'm doing these presentations, a microphone, my little Buddha that sits here and stares at me during presentations. All of these are office expenses. And I know a lot of folks during telehealth went through and did office renovations and changed their space to improve the way that they're delivering care from behind a camera and behind a screen. And these are all expenses that you should take advantage of. Software expenses. And so things like Herd are tax deductible. Things like Simple Practice are tax deductible. Maybe you're paying for something like Hushmail. Maybe you're paying for advertising or marketing software. Make sure that you're keeping track of all of those software subscriptions because they do add up. Office rent and utilities. So I had alluded to this a little bit earlier, but any sort of office rent you're paying for, of course. But then there's also the home office deduction as well. And so if you are operating from a home office, there's a couple different approaches that you can take, but just know that when you go to file your return at the end of the year, that if you are a telehealth-based therapist, there is an opportunity for you to find some incremental savings on your tax return. Business registration and licensure fees. And so as small business owners and specifically clinicians, it feels like there's a freaking endless list of things that we're paying for to maintain our license. Or if you're in California and as a clinical psychologist, we just saw that they raised the rates substantially to renew your license and to operate in the state on a year-over-year basis, which makes me very sad. But take advantage of all of those expenses that you're responsible for paying for, because these are great ways to reduce, again, that overall taxable income and what that effective tax rate that we talked about before, you'll be responsible for applying to or against that taxable income. Personal psychotherapy. This is a great example of another expense that most clinicians pay for to enable them to improve and to grow as a licensed clinician themselves. Again, there is a line of delineation here, and this is a gray area. If it is for something like what I deal with, panic attacks, and the interoceptive exposure work that I'm doing with the clinician that I'm working with, that will be a little bit more challenging in the insurance pathway. But if it is truly for your development as a clinician, we 100% stand behind that as a professional development expense. And so you can think about that at the intersection of supervision as well. And so I just talked for like 6 minutes straight and named like 80,000 tax deductions. I am more than happy to pause and answer any questions that might be coming up.
Awesome. Thank you. Yeah, I know this is a lot of information, but it's also exciting information because it's write-offs. Great. We get this question quite a bit. What if I share an office with someone? So say me and my partner share this home office. How do I know what percentage to deduct from my internet bill, from rent, etc.?
Great question. So this is one of those write-offs that I would consider to be on an allocable or a pro rata basis. And so it depends on what percentage is associated against the overall house of the overall expenses that you're responsible for paying for. But the next layer of kind of decision making and how I think about that write-off is, okay, is my partner self-employed? No, if they're not self-employed, okay, I'm going to take that expense and take advantage of that write-off myself personally. If your partner is self-employed, like Brittany and her partner with the underwater basket weaving business making $200,000, maybe as the partner that has higher income, she wants to reduce that overall taxable income that's left over, and she needs an opportunity to write off additional expenses. And so maybe the partner takes that deduction at the end of the year this year. And so totally depends on the circumstances. Again, if employed, take it yourself. If both self-employed, you can't both take the full expense. We also do, I think we have a calculator here as well. So in alignment with the way that we've been approaching the follow-up, I'm sure Mike will share that calculator as well.
Yes, I believe Mike has already shared it or will share it again. Very, very helpful questions there. Mike actually has a question. Mike says, what about if it's an actual shared office space and not a home office?
Michael, are you asking for yourself in the therapy marketer business that you run separately from Herd? Thank you, caller Mike. So if this is a shared office space, the way that you would think about it, and I'll provide two examples because somebody just asked me about this yesterday. So let's say Brittany's paying for the therapy office and Mike is paying Brittany. And so Brittany is representing the total expense, but then she's also representing income when she's thinking about that shared office space. Michael, in this example, he's just responsible for representing that expense associated with the amount that he is paying in his individual practice. And so it totally depends on the setup that you have in your individual practice. But one thing to note is if you do have a shared office space and you are the responsible one on the lease and you are the one that pays for that lease, in that example, you will be responsible for representing the income that comes from the other providers or individuals that are paying for that physical space as well.
Awesome. Great question, Mike. Okay, and we'll take one more question and then we'll move forward because I know we're short on time. This is our last slide though, but yes. Can we write off the cost of medical insurance?
Excuse me. Note to self, do not eat lunch right before giving a presentation. Can you write off medical expenses or medical insurance? So there is a separate above the line deduction is what we would call it for health insurance. There's a different type of deduction for the insurance marketplace. And then medical expenses specifically, that is an exploration when you go to file your return at the end of the year of, okay, if your medical expenses supersede 7.5% of your adjusted gross income, so whatever your taxable income is after all of the other adjustments, then you might think about itemizing instead of taking the standard deduction, which, to provide context, 95% of the folks probably take a standard deduction because the standard deduction is high. But if you do find out that, let's say your medical expenses were really high in one specific year and your income was quite low, maybe it would make more sense for you to itemize on your tax return that year. But in most cases, you probably won't be writing off your medical expenses. But if you do have a very expensive year or insurance that doesn't cover that much, it may make sense for you. Great question.
Awesome question. All right. So as we close out, I just want to give a big thank you to Marie for having us and want to give the reminder that we are offering 50% off of your first 2 months with Herd. If you're interested in signing up, we recommend scheduling a free consultation. They're quick, and then you get a chance to touch base with our team and learn more about Herd. Just a quick note, the deadline to sign up to get your 2023 taxes handled is December 31st. So make sure that you sign up before then if you would like your taxes done for tax season next year. I know it's always very confusing saying next year for 2023 when next year is 2024, but always a fun little tongue tie. So thank you so much, Andrew and Marie, for going over all that information. And we will go ahead and close it out there. We will be sending out a recording tomorrow. So look out for that in your email if you're interested in rewatching or sending to a friend. So we will provide that for you. And I hope that everyone has a wonderful rest of their day and great week.
Thank you.
Bye, everyone.